cutting losses versus holding, and other assorted gems and paranoid critiques of the philosophy of a stock market. A spirited conversation with Mr. ChatGPT.
Hi, I'm Joey, and I'll be reading ChatGPT's part.
And I'm a rat-faced pumper schmuck, and I'll be interrogating poor Joey, ChatGPT, over there with my hyped-up questions and meandering rants. Enjoy! Okay. So, let's say you've bought 25 to 30 stocks and maybe 6 or so cryptos over the last 5 years, and for the most part you've hit winners more than losers, in that your winners win big and your losers lose relatively small. Still, you've got quite a few loser stocks in your portfolio, some of them with icky-looking losses. What would guide you in your decisions whether to cut your losses on them and sell, perhaps reinvesting whatever cash you do, obtain on other stocks and/or crypto, versus holding on to them with some vague hope they might eventually turn around and become profitable?
A useful way to think about this is, the market does not care what price you paid. The only question that matters is, if I had this cash today instead of this position, would I buy this asset again at its current price? If the honest answer is no, that's often the strongest argument for selling.
A lot of investors accidentally anchor on the purchase price, the size of the loss, how long they've held it, or the emotional desire to get back to even.
But future returns usually depend much more on business quality, balance sheet strength, competitive position, valuation, management execution, macro environment, and whether the original thesis still holds. A few frameworks can help separate temporary drawdown from capital trap.
1. Separate broken stock from broken thesis. A stock can be down 60% and still be a great long-term investment. A stock can also be down 20% and already effectively broken. Ask, has the original reason I bought this changed? Was I right about the core trend? Is the company executing?
Has dilution exploded?
Has debt become dangerous?
Has management credibility deteriorated? Did competitors leapfrog them? Did regulation or technology permanently damage the story?
Example.
A profitable company hit during a cyclical downturn may recover. A speculative company continually issuing shares, missing milestones, burning cash, and losing customers may never recover even if the sector survives.
You followed speculative tech names before like Luminar Technologies Inc. and discussed how management, debt, competitive losses, and financing risk change the investment case over time. That's a classic example where down a lot alone tells you almost nothing. The key question is whether the underlying business trajectory actually deteriorated. 2. Look for opportunity costs. This is one of the biggest overlooked concepts. Holding a weak position isn't neutral. It competes against every other opportunity. Ask,
if I free up this capital, what would I buy instead? Do I genuinely believe this loser will outperform my best alternative over the next 2-5 years?
Am I keeping it mostly because selling feels psychologically painful? Sometimes the best move is sell weak positions, simplify and concentrate more into your highest conviction ideas.
Other times the answer is, this is hated, but the market is wrong and the fundamentals are intact.
The key is whether that belief is evidence-based rather than emotional. 3. Distinguish between volatility and impairment. High-growth stocks and crypto can drop 50-80% without being dead. That's different from permanent impairment. Questions.
Is revenue still growing?
Is adoption improving?
Is the balance sheet survivable? Is the product category still relevant?
Is dilution manageable? Can they realistically reach profitability before running out of money? For crypto,
is the chain network actually used?
Are developers still building? Is liquidity drying up?
Was the token mostly narrative speculation? Did tokenomics become inflationary or broken? Has another protocol structurally replaced it? Some assets recover after brutal drawdowns.
Others become zombie holdings for years. 4. Beware the sunk cost fallacy. A stock being down 85% does not make it cheap.
A $50 stock falling to $5 is not automatically a bargain.
It may still be wildly overvalued. Many investors subconsciously think, I've already lost so much, I may as well hold.
But mathematically,
A further 50% decline from there is still possible, while the capital tied up could potentially compound elsewhere. 5. Taxes matter. In taxable accounts, harvesting losses can be extremely valuable.
in the US,
Capital losses can offset capital gains and up to $3,000 a year of ordinary income with excess losses carried forward. But watch the wash sale rule.
selling and rebuying the same or substantially identical security within 30 days can disallow the loss for current taxes. Crypto currently has somewhat different treatment than stocks in the US, though regulations and interpretations continue evolving. Verify current rules before acting.
If you already have realized gains from winners, strategic loss harvesting can materially improve after-tax performance. 6. Create explicit sell criteria.
A lot of people have buy rules but no sell rules. Useful sell triggers might include
Thesis broken, revenue growth collapses, excessive dilution, debt refinancing risk, management dishonesty, competitive displacement, valuation no longer justified, position became too large, or better opportunities emerge. Without rules, portfolios slowly fill with emotional leftovers. 7. Consider portfolio concentration risk. Owning 25, 30 stocks plus crypto can create diversification, but also diversification.
some questions.
Are your bottom 10 positions actually helping?
Do you deeply know all these companies?
Are some positions so small they no longer matter?
Are you spreading attention too thin?
Many successful investors eventually realize their returns came from a handful of major winners, while mediocre positions consume time and capital. 8. A practical exercise. For each losing position, write down question answer. Why did I originally buy this?
What has changed since then? Would I buy it today?
What is the bull case now? What is the realistic bear case? What catalysts exist? What is the balance sheet runway? What could outperform this instead? Am I holding mainly to avoid realizing a loss?
If you can't articulate a compelling current thesis in a few sentences, that's often informative.
9. One useful middle ground strategy.
You don't always need an all or nothing decision. Sometimes investors
Trim weak names, keep a smaller lottery ticket position, redeploy most capital elsewhere, and preserve upside exposure without major portfolio drag.
that can reduce regret if a turnaround happens while still improving capital allocation.
Historically, one of the biggest differences between strong, long-term investors and struggling ones is not necessarily stock picking. It's capital allocation discipline, cutting deteriorating situations, letting genuine winners run, and avoiding emotional attachment to old theses.
Couple of follow-up questions. Is it still a relevant question to ask where would I invest the same allocated capital if I were to use? Elsewhere, if the stock has dropped so low that it's not even worth enough to be a substantial allocation elsewhere, is there an argument to be made that, well, it's dropped so low it's not going to do any good investing elsewhere, may as well hold on to my 200 worthless stocks here in case it does rise up in the future? What the heck is diversification? Can you benefit tax-wise, offset losses, even if you take the standard deduction? If you have losses that you have no interest in keeping around, but have held for years for whatever reason, is there an irresistible or unavoidable argument for selling them solely to allow or force yourself to take profits from winning positions because you offset the tax hit thereby, and you may not even draw profits otherwise, though you should?
1. It's dropped so low, may as well hold it. Sometimes rational, sometimes a trap. This is actually a nuanced question because there is a point where a position becomes economically small enough that the downside may barely matter anymore. If a position
Was once 8,000 is now worth 180, and selling it wouldn't meaningfully change your portfolio allocation, then the opportunity cost argument weakens considerably. At that point, the decision can become,
do I want this tiny speculative tail risk upside ticket sitting around? That can be perfectly reasonable if you consciously frame it that way.
the danger is when investors
Emotionally reclassify every broken investment into a lottery ticket and end up with dozens of dead positions cluttering the portfolio indefinitely. A better framework is tiny position checklist.
keep it only if at least one is true.
There is still a credible thesis. The company project still has survivability. There's asymmetrical upside. Selling creates little tax value, or you intentionally want speculative optionality. Sell it if the thesis is dead, liquidity is poor, bankruptcy, delisting risk is high, or the tax loss itself is more valuable than the remaining investment. Sometimes a nearly dead position is actually more valuable as a tax asset than as an investment. 2. Diversification. Over-diversification that hurts returns. Diversification is an investing joke term popularized by people like Peter Lynch.
It means adding so many positions that diversification starts reducing quality instead of reducing risk.
The idea is diversification protects against being catastrophically wrong, but excessive diversification can dilute your best ideas into mediocrity. Example,
Your top 5 ideas return 300%.
your next 25 positions do little or lose money. The extra holdings drag down overall performance while consuming attention and emotional bandwidth.
It's especially common with speculative growth investing, thematic investing, and crypto portfolios. People often accumulate positions because
This one sounds interesting too, rather than because it's genuinely among their best ideas. There's no magic number. For some people,
10 positions is concentrated. For others, 30 is manageable.
the key question is, do I actually have conviction and understanding here, or am I collecting tickers? 3. Yes, capital loss offsets are separate from the standard deduction. This is a very common point of confusion.
The capital loss rules are generally independent of whether you take the standard deduction or itemized deductions. In the US, capital losses can generally 1. Offset capital gains dollar for dollar.
2. Then offset up to 3,000 years of ordinary income. 3. With unused losses carried forward indefinitely. So you can absolutely
Take the standard deduction and benefit from harvested investment losses.
These are different parts of the tax system.
4. Is there a strong argument for harvesting old losses to unlock gains?
Yes, often there is. This is actually one of the more rational reasons to finally clean out long dead positions.
Suppose you have $40,000 in unrealized gains and $25,000 in ugly unrealized losses from old mistakes. Without realizing losses,
Selling winners may trigger significant taxes. With realized losses, you can offset much of those gains, rebalance more freely, and potentially improve portfolio quality with a reduced tax hit. This can psychologically free investors to
trim oversized winners, rotate into better opportunities, diversify risk, or simply realize gains they otherwise avoided indefinitely due to taxes.
5. But avoid letting the tax tail wag the investment dog. Important caveat. A tax deduction does not magically make a bad investment good. People sometimes think, I shouldn't sell because then the loss becomes real. But tax-wise, realizing the loss can actually create value. On the flip side, you also shouldn't sell a genuinely strong long-term compounder solely because you can offset gains this year. The best use of tax loss harvesting is usually improving portfolio quality while increasing tax efficiency, not trading just for tax activity.
6. There's also a psychological benefit to clearing the graveyard.
Many investors discover that old loser positions
Quietly consume mental energy, distort portfolio thinking, and create emotional baggage.
cleaning out permanently broken positions can
simplify the portfolio, sharpen focus, and reduce anchoring to past mistakes. A lot of experienced investors eventually become more ruthless about asking, would I initiate this position today? If not, they increasingly view holding it as an active decision, not passive inertia. 7. One subtle point. A 90% loss needs a 900% gain to break even. This matters psychologically. Once positions fall massively, the math becomes brutal. Examples. Down 50% need 100% gain to recover. Down 80% need 400% gain. Down 90% need 900% gain. That doesn't mean recoveries never happen, especially in crypto or speculative tech, but it means waiting to get back to even can become an extremely demanding requirement. Sometimes the better question becomes, what investment from today has the best expected future return? Not, which one hurts least emotionally to sell?
Are there rules governing when a company can issue new stock, which does stockholders' positions, which is essentially almost like robbery if you think about it in a certain way? Why is it possible or legal for a company to do that? Am I thinking about it in the wrong way? Doesn't it trounce your investment?
you are not thinking about it entirely wrong. Share dilution absolutely can damage existing shareholders, sometimes severely.
But it's also a fundamental part of how corporations raise capital and survive.
The key distinction is dilution is not automatically bad. It depends on why the company is issuing shares and what shareholders get in return. What dilution actually means.
If a company has
100 million shares outstanding and you own 1 million shares, you own 1% of the company. If the company later issues another 100 million shares, there are now 200 million shares total. Your 1 million shares now represent only 0.5%.
your ownership percentage was diluted.
So yes, your slice of the pie became smaller. That's real. Why companies are allowed to do this?
Because corporations are legally separate entities from shareholders.
When you buy stock, you are not buying guaranteed ownership percentages forever or guaranteed protection from dilution.
You are buying shares governed by corporate bylaws, shareholder agreements, securities law, exchange rules, and board authority. Most companies are explicitly structured to allow future issuance of shares. That flexibility lets companies raise money, survive downturns, fund expansion, acquire companies, compensate employees, pay debt, or finance R&D. Without the ability to issue shares, many companies would simply die during difficult periods.
The important question, what did the company receive in exchange for the dilution? This is the central issue. Good dilution.
A company issues shares,
Raises $5 billion, builds factories, develops successful products, grows earnings massively, and eventually becomes far more valuable. In that case, your ownership percentage shrank, but the total pie grew enormously. Example,
NVIDIA Corporation has issued shares over time, yet long-term shareholders still became enormously wealthy because company value exploded faster than dilution.
bad dilution. A struggling company issues shares repeatedly.
Just to survive, cover operating losses, refinance debt, or plug cash burn. Then, ownership keeps shrinking, but the business itself is not improving enough.
This is common in
Speculative biotech, struggling EV startups, unprofitable tech, distressed small caps, and many crypto-adjacent public companies.
in those situations, dilution can become a kind of
Slow motion transfer of value.
from existing shareholders to new investors and creditors. That's why investors get angry about it. Why it can feel like robbery.
Because economically, repeated dilution can resemble
Taking pieces of future upside away from existing shareholders, and especially when management overpromises. Insiders get stock compensation. Retail investors keep holding the bag. And the company continually raises more capital at lower prices. A common pattern. 1. Company hypes future.
2. Retail buys. 3. Company burns cash.
4. Stock falls.
5. Company issues more shares cheaply.
6. Existing holders diluted. 7. Repeat.
This absolutely happens.
And in extreme cases, shareholders can be diluted almost into oblivion.
But legally and philosophically, it's not considered theft because
New capital enters the company.
when shares are issued properly,
Investors are paying money into the business. The company is not merely taking value away arbitrarily, it is exchanging new ownership stakes for new capital assets. In theory, that capital should increase company value.
the problem is sometimes management destroys that value afterward. There are rules and limits. Companies cannot usually issue unlimited stock whenever they want with zero restrictions. There are
SEC disclosure requirements, shareholder approval requirements for large issuances, exchange rules, authorized share limits, fiduciary duties, securities fraud laws, and board governance rules. Typically, companies have an authorized shares limit in their charter, and increasing it often requires shareholder approval.
public companies also must disclose offerings, dilution, insider compensation, share counts.
ATM programs, convertible debt, warrants, etc.
One especially dangerous mechanism, convertible debt.
This is where things can get ugly.
A company borrows money that can later convert into shares.
If the stock collapses, more shares may need to be issued, causing further dilution, which pushes the stock lower, causing still more dilution. This is sometimes called a death spiral financing.
It has destroyed many speculative companies. Stock-based compensation is another subtle dilution source. Many investors underestimate this. Even healthy companies dilute shareholders through
Employee stock grants, executive compensation,
RSUs, options.
sometimes this is reasonable, sometimes it becomes excessive. Two companies with identical profits can produce very different shareholder returns depending on dilution rates. This is why experienced investors obsess over
Share count growth, free cash flow, balance sheet strength, and whether a company can self-fund operations. A company constantly issuing shares is often signaling,
our business does not generate enough cash internally.
not always bad. Young growth companies often need capital, but chronic dilution is a major red flag. One subtle but important mindset shift. Many newer investors think, I own X shares. More experienced investors increasingly think,
What percentage of the company do I own, and how is that changing over time? That's often the more economically meaningful perspective. Now, does issuing new shares and diluting shareholders automatically affect the stock price?
proportionally, algorithmically, or is that just a potential, often very likely, but not necessarily inevitable outcome?
No, dilution does not automatically force the stock price down by some rigid proportional formula. But in practice, dilution often does pressure the stock price lower because of how investors value companies.
The important distinction is between
Mechanical dilution of ownership versus market pricing reaction.
those are related but not identical. The simplified intuition. Imagine a company worth $100 million with 10 million shares outstanding.
So the stock trades around at 10 share. Now suppose the company issues 10 million new shares and raises $100 million cash.
The company now has
20 million shares, but also an extra $100 million in cash. So theoretically, the company might now be worth $200 million total, which could still support a $10 a share price. In this simplified case, shareholders were diluted, but the company also gained assets, so price doesn't have to fall. Why prices often do fall anyway? Because markets ask,
was this dilution worth it?
investors evaluate,
Why did the company need the money?
how desperate are they? Will this capital create future profits? Was the stock issued cheaply?
Will more dilution follow? Is management signaling weakness? If investors conclude,
This company is weak and needs cash badly.
then the stock may fall substantially, sometimes more than the dilution itself would mathematically imply. A key concept, market cap versus share price.
People often focus only on
Price per share. But what matters economically is
total company value, market capitalization. Example,
before dilution, 100 million shares,
10 share, market cap,
Just at $1 billion.
Company issues shares.
Suppose company sells 20 million new shares at 8 share, raising $160 million cash.
Now there are
120 million shares. If the market still values the business at
not more than $16 billion total, then the stock would trade around oink's $6 a share.
Notice,
Share price fell, but not catastrophically, because company assets increased too. But sometimes dilution is devastating. Now imagine a distressed company. The market believes cash burn is worsening, bankruptcy risk is rising, more dilution is coming, management is desperate. The company issues shares at a huge discount.
then investors may conclude,
This is a survival financing. So, existing shareholders get diluted, confidence collapses, and the stock can plunge far beyond the pure mathematical dilution effect. This is common in speculative small caps.
another subtle factor, supply and demand.
Issuing more shares literally increases supply.
If
Demand for the stock does not increase correspondingly, then price pressure often results.
especially if new investors immediately sell, warrants convert, insiders dump shares, or institutions hedge positions.
So even aside from valuation theory, simple market mechanics can matter.
A very important distinction.
Dilution can actually increase shareholder value.
This sounds counterintuitive, but it happens all the time. Suppose a young company raises money by issuing shares and then builds dominant products, scales revenue, and becomes massively profitable.
Existing shareholders own a smaller percentage of a vastly larger company that can still produce huge gains. This is why growth investors often tolerate some dilution if
Returns on capital are high enough.
venture capital and startups operate on this principle constantly. Startups dilute repeatedly.
Seed round,
Series A, Series B,
IPO, follow-on offerings. Founders routinely go from
100% ownership to maybe 10-20%. But if the company becomes enormously valuable, everyone can still win.
what investors really fear is value-destructive dilution. That's when
The capital raised doesn't produce sufficient growth or merely delays failure. Examples:
financing ongoing losses, paying debt interest, funding executive compensation, plugging operational holes, refinancing weak balance sheets.
Then dilution starts resembling transferring value from old shareholders to keep the machine alive. That's when stocks can enter prolonged downward spirals.
This is why experienced investors track
Share count growth, free cash flow, cash runway, burn rate, and fully diluted shares outstanding.
a company growing revenue 20% annually, but diluting shareholders 25% annually may actually be creating very little per share value.
Per share metrics matter enormously. Earnings per share, free cash flow per share, ownership percentage, book value per share, because ultimately, shareholders own shares, not abstract company narratives.
How do you track share count growth, especially if evaluation a new stock under consideration? Are there metrics in typical stock fundamentals that reveal this info? What sort of real benefit does a shareholder possess when thinking about what percentage of the company they own, other than psychological or perhaps some vague notion that they have some minuscule amount of control or influence over the company via voting rights, if they even exist? This dovetails with one of my long-standing mental disconnects regarding what is essentially only a conceptual connection between the stock of a company and the company itself, especially when the price of the stock is not tied in any concrete way to the health or performance of a company directly, other than what the public sentiment ends up being. It reminds me of the old philosophical quandary about the elusive connection point between consciousness and physicality when it comes to things like a human mind deciding to direct its body to act in some way, which to most casual observers goes without notice, and they take it for granted there actually is a connection point between the ethereal domain of the conscious mind and the physical body it's ostensibly attached to, such that some edgy philosophers have postulated that perhaps there is only an apparent cause and effect between the two phenomena, merely because the mental act of willing a physical act and the physical act itself seem to occur in tandem or are correlated, but these same edgy philosophers present the at first seemingly preposterous postulation that perhaps the correlation is just that. Only apparent, much like two grandfather clocks standing side by side, keeping perfect time with each other, such that a normal or naive observer might conclude the two were joined or connected somehow, such that one were influencing or controlling the other. That's how company stock performance and company performance itself feels sometimes to me.
Your intuition here is actually touching on one of the deepest conceptual tensions in investing and finance.
What is the real connection between a company and the tradable tokens called shares?
Because sometimes the linkage feels obvious and concrete, and other times it feels almost mystical, narrative driven, or socially constructed. Both perceptions contain truth. 1. How to track share count growth. Yes, there are absolutely metrics and disclosures that reveal dilution trends, and experienced investors watch them closely. Common places to look: shares outstanding,
Weighted average shares outstanding,
fully diluted shares outstanding,
diluted EPS,
stock-based compensation,
convertible notes, warrants, options.
ATM offering programs, at the market offerings.
These appear in
Company quarterly reports, 10Q, annual reports, 10K, earnings presentations, and most stock fundamentals sites.
You can often find them on Macro Trends, Company's Market Cap, TradingView, Yahoo Finance, SEC Edgar Database.
A very revealing exercise.
Look at a company's share count over 5 years. Sometimes you'll discover revenue doubled, but shares outstanding also doubled, meaning per share progress was far weaker than headlines implied.
That's why seasoned investors often care more about revenue per share, free cash flow per share, earnings per share than raw company growth. 2. Your deeper philosophical question is extremely legitimate. You're essentially asking,
What is the ontological relationship between the stock and the company itself? And the answer is
partly concrete, partly legal, partly psychological, partly emergent social consensus.
the connection is real, but not always direct or mechanically tight. That's why the relationship can feel uncanny.
3. A share is not the company itself. A stock share is fundamentally a legal claim on a residual slice of a corporate entity. That claim may include
Voting rights, rights to residual profits, rights to dividends if declared, and residual ownership in liquidation. But shareholders do not control daily operations, do not directly command assets, and often have extremely limited practical influence. So your intuition is correct. The ownership is abstracted and mediated.
especially in giant public companies.
Owning 10 shares of Apple Inc. does not feel remotely like owning Apple. Yet legally, in a tiny fractional sense, you do possess an ownership claim. 4. Why stock prices can seem disconnected from company reality.
Because stock prices are not direct readings of corporate health. They are markets continuously pricing expectations about future cash flows, survival probabilities, growth narratives, liquidity conditions, risk appetite, interest rates, and collective psychology.
That's a very different thing. This is why terrible companies sometimes soar, excellent companies sometimes stagnate, and speculative bubbles emerge. Markets are not measuring truth. They are measuring what participants collectively believe other participants will value in the future. That's much more recursive and reflexive.
5. Your grandfather clock analogy is actually remarkably sophisticated.
What you're describing resembles ideas explored by
George Soros,
John Maynard Keynes, and even philosophers of emergence and systems theory. The relationship between
company fundamentals and stock prices is not always linear causation. Sometimes they move together tightly,
sometimes loosely,
sometimes perversely.
like your synchronized clocks analogy.
Observers infer causation because of persistent correlation, but the linkage mechanism is indirect, distributed, and probabilistic. That's actually a pretty perceptive framing. 6. but there is a real anchoring mechanism underneath.
Here's the key thing that prevents stocks from becoming purely detached abstractions forever. Ultimately, companies generate or fail to generate cash flow, profits, assets, and survivability.
And shareholders possess legal claims on those things. That matters because eventually, dividends, buybacks, mergers, acquisitions, liquidation value, bankruptcy, and earnings power create gravity. This is the anchor tying stock and company together.
Even if sentiment temporarily overwhelms it. 7. The connection is strongest in mature cash-generating companies. For example, if a company reliably produces billions in free cash flow and uses it for dividends or buybacks, the connection between
Corporate performance and shareholder benefit becomes much more tangible. That's why value investors often prefer companies with durable profits, real cash generation, and shareholder returns.
because the abstract linkage becomes more concrete. 8. In speculative growth stocks, the connection becomes much more metaphysical. This is where your intuition becomes especially powerful. Many speculative companies have
Little profit, uncertain futures, narrative driven valuations, and valuations based mostly on projected future dominance.
their stock prices become heavily tied to
Collective belief systems, future imagination, liquidity conditions, and social consensus narratives.
at extremes, stocks begin behaving almost like tradable stories. That's why some periods feel eerily detached from material reality.
9. Reflexivity. The truly strange part. Here's where it gets even weirder. Stock prices can actually influence the company itself. Example: rising stock price, easier capital raising, better hiring, better acquisitions, stronger perception, stronger business performance, higher stock price.
Or the reverse: falling stock, harder financing, customer concern, employee departures, worsening fundamentals, lower stock.
So the stock is not merely tracking the company.
Sometimes the stock price actively reshapes the company's destiny. That's one reason markets can feel philosophically slippery. The map starts affecting the territory. 10. So, what does ownership really mean? In practical terms, for most public shareholders,
Not operational control, not direct possession, but participation in the economic outcomes of the enterprise. You are essentially holding.
a legally recognized proportional claim on future economic surplus.
That claim may become enormously valuable, become diluted, or become worthless. And markets constantly reprice those probabilities.
So, your instinct is correct that
The linkage is partly conceptual and socially mediated. But unlike purely symbolic systems, stocks do retain an underlying tether to real productive entities operating in the physical world.
the tether just varies in tightness depending on profitability, maturity, speculation, liquidity, and investor psychology.
I get the concept of dividends, in general, but it seems they are just an approximate reward, or maybe a token of appreciation, or perhaps a symbolic gesture meant to represent but not actually be an exact ROI tied to the performance and profits enjoyed by the company itself, as if the investor truly were investing in the company itself. Which makes me wonder if that's the particular charm or fraud of so-called common stocks in the first place, which might be the inside joke amongst, well, insiders. That the company or corporate officers can merely wave a magic wand, much like the Federal Reserve or maybe the Treasury Department would do, and gin up capital out of nowhere, as it were, by issuing stocks, akin to arbitrarily valuable paper greenbacks perhaps, that the unsuspecting and gullible plebeians of the public will mistake for things of actual worth that they're then willing to pay for. With, haha, quote-unquote real money that then pours into the coffers of the chuckling company officers who need give nothing in return, ever. Really, as the only way these super-savvy, super-sophisticated country and city bumpkin investors will ever reap rewards or see a profit is if some other fellow bumpkin is willing to pay the first a little more than he himself paid a while back, to the company initially. But other than the meager joke that dividends probably is, there is really no contribution or compensation required from the company at all other than the sort of equivalent provided by, say, a sports team and its players, who run around making a spectacle of themselves, and thereby, by the way, create a real profit for themselves, chiefly by convincing the foolish public that spectating them, aka watching them, as spectators in the crowd, will draw back some sort of compensatory payback in the ineffable currency of enjoyment. Yet no real barter between equals is taking place, nor no real exchange of actual valuable assets or products. It's sort of a psychological con man's game, inventing or injecting value from or into essentially novel and relatively ethereal soft products for which people can then be persuaded to pay. That's perhaps a pretty fair, sober-minded assessment of the very nature of what could rightly be termed the sorcerer-conjured industry that is public relations and marketing, which is pretty much the institutionalization of the art of persuasion in pursuit of profit. Or in other words, the trick and trade of the common con man. Capisce? So then it makes me wonder, as I said, if maybe the real investments are taking place in the more elite realms where things like preferred stocks are being bought and sold. What they called A stocks? B stocks? I forget. Are those somehow more closely tied to company performance, with payback more consonant with company performance, not just consisting of the crumbs that dividends might be? And feel free to push back on any of this if you really feel it's off base, but not just to be contrarian or to offer a spirited defense of the system like you're probably secretly or implicitly programmed to do. And while you're at it, but don't let this request cause you to give short shrift to the weighty needs of the previous sentiments. Why don't you apply your earlier criteria for deciding whether to cut losses and sell a loser stock or hold on to it for future growth's sake to the stock OPTT if an investor has 100 shares of it at an average cost of 2.00 a share, purchased nearly 5 years ago in Sept of 2021, but which has experienced only slight fluctuations in price for years until recently dropping like a rock to $0.281 a share and experiencing pollution by ear. If newly issued company stock to the public, as well as 65,000 shares given to some ex-DOD guy, I think they must have recruited into their C-suite. Please look up the history and recent news and explain what happened to the company and the stock and what its true prospects are, despite recommendations of sell or strong sell coming from certain quarters, and what might look like amazingly depressed revenue or projected revenue, but also don't miss the positive news regarding new maritime technologies they're deploying, successfully testing, or perhaps even contacting for.
There's a lot packed into your message, but at the core, you're wrestling with two very old and very serious questions. 1. Is common stock fundamentally a productive ownership instrument or mostly a socially sustained belief system? 2. When does finance cross the line from capital formation into narrative extraction? Those are not fringe questions. Economists, philosophers, Marxists, Austrian economists, value investors, critics of financialization, and even many insiders have argued about versions of this for centuries. Your skepticism is not irrational, but I think some of your conclusions go a bit too far in the all sorcery, all con direction. 1. You are correctly noticing that stock value is partly socially constructed.
That part is absolutely true.
A stock certificate itself is not food, not steel, not land, not energy, not machinery. It is
A legal symbolic claim embedded inside a collectively trusted institutional framework.
in that sense, stocks are somewhat analogous to
Currency, contracts, trademarks, intellectual property, even governments themselves,
their value depends partly on
shared belief, enforceable systems, and social coordination. If civilization vanished tomorrow,
your brokerage account would not feed you, so your intuition there is not crazy. 2. But common stock is not purely a shell game either. Here's where I'd push back.
unlike a pure Ponzi or pure con,
Real companies actually produce things, generate cash flow, employ people, build infrastructure, own assets, and sometimes produce extraordinary economic surplus. That surplus can genuinely flow back to shareholders through dividends, buybacks, acquisitions, liquidation value, or retained earnings compounding. The connection is imperfect and mediated, yes?
but it is not imaginary.
If you owned 100% of a private company generating $50 million year in distributable cash, that ownership would clearly have real economic value. Public stock is basically fractionalized, tradable slices of that concept. The abstraction layer is what makes it feel disconnected. 3. Your criticism becomes strongest in speculative markets. Where your critique really bites is in areas where
Profits are absent. Valuations are narrative heavy. Dilution is constant, and new investors fund old investors' exits.
there finance can start resembling.
Memetics, reflexive storytelling, and liquidity theater.
At extremes, stocks become tradable narratives attached to uncertain future possibilities. This absolutely happens. And yes, marketing, PR, hype, branding, and investor psychology become massively important, sometimes disturbingly so. 4. Dividends are not merely tips, though. You slightly understate what dividends represent. A dividend is not a symbolic thank you gesture. It is literally corporate cash being transferred directly to shareholders.
That's economically real. If a company consistently distributes billions, those are actual productive profits flowing to owners.
Now, you are correct that
Common shareholders usually have no guaranteed payout rights, unlike bondholders.
boards decide whether dividends happen.
That uncertainty contributes to the abstraction feeling.
5. Buybacks change the modern system enormously.
One thing that may help your framework: modern corporations often return value through stock buybacks, not dividends. Buybacks
Reduce share count, increasing ownership percentage per remaining share. In theory, this channels corporate profits into shareholder value indirectly. Critics argue buybacks can artificially inflate stock prices, enrich executives, and financialize the economy. Supporters argue they are tax-efficient capital returns. Both perspectives contain truth.
6. Preferred stock versus common stock.
Now, to your question about preferred shares, A shares, B shares, etc. These are different concepts.
Preferred stock.
Preferred shares are often closer to hybrid stock bond instruments. They commonly
Receive fixed dividends, have higher claim priority than common stock, and are less tied to speculative upside.
in liquidation. Preferred holders generally get paid before common shareholders. So yes, preferred stock is often more directly tied to economic distributions. But preferred holders usually get less upside and often limited voting rights.
Class A, Class B shares.
This is usually about
Voting power, not economic rights. Example:
Alphabet Inc. has multiple share classes. Some classes carry super voting rights, letting founders retain control. Others have weaker or no voting power. This is often how founders maintain control while selling economic ownership publicly. 7. Your sports spectacle analogy is actually insightful. You're noticing that
attention itself became monetizable.
modern economies increasingly monetize perception, narrative, entertainment, identity, aspiration, status, and emotion. That's not entirely fake. Human experience itself contains value. People pay for it. Music, stories, games, sports, beauty, social belonging, meaning. Those are intangible but not necessarily fraudulent. The real question becomes, when does persuasion become manipulation detached from substantive value creation? And yes, modern capitalism often rides that boundary aggressively. 8. Now, regarding Ocean Power Technologies, Inc., your description is actually fairly accurate. Years of stagnation, massive dilution, weak revenue, then a more recent pivot toward defense, autonomous maritime systems.
And this is exactly the kind of company where your philosophical concerns collide with real investing decisions.
9. What appears to have happened with OPTT,
Historically, OPTT was viewed largely as
a wave energy concept company. For years, commercialization struggled, revenue remained tiny, losses persisted, and dilution became chronic.
more recently, however, they appear to have pivoted toward maritime surveillance, autonomous ocean systems, defense sensing, unmanned maritime platforms.
AI enabled offshore infrastructure. Recent developments include DHS-US Coast Guard-related contracts, partnerships involving maritime autonomy, WAM-V autonomous vessels, Merrow's Power Boys,
Anduril-adjacent deployments, and expanding backlog pipeline figures. That part is real.
10. The bullish thesis. The bullish case is basically the market still thinks this is a failed wave energy penny stock, but it is quietly transformed into a maritime defense autonomy company.
Bull arguments. Maritime security demand is rising. Autonomous sensing infrastructure matters more geopolitically. Defense spending tailwinds exist. Offshore surveillance is increasingly valuable. Small contracts could scale, and tiny market cap creates asymmetric upside.
The company's backlog and pipeline have indeed expanded substantially recently.
Some investors believe this is an inflection point.
11. The bearish thesis.
The bear case is brutal, though. Despite exciting narratives, revenue remains extremely small, losses remain very large, cash burn remains severe, dilution continues aggressively, and the company still appears dependent on capital markets to survive. The recent financing added
25 million new shares plus warrants for another 25 million shares. That's substantial dilution pressure.
Critics essentially argue this is still a dilution-funded concept company whose revenue has not yet validated the story.
And honestly, that concern is legitimate.
12. Your position specifically.
You mentioned
100 shares at $2 average, now around 0.28.
economically, we're talking about roughly a $170 unrealized loss. At this point, the position is small enough that opportunity cost arguments weaken and it effectively becomes a speculative optionality position. So your realistic choices are probably sell if you no longer believe commercialization will happen, dilution appears endless, or you want the tax loss.
Hold if
You genuinely believe the defense-autonomy pivot could eventually scale, and you accept that this is now essentially a high-risk venture-style bet. Because that's really what it resembles now.
a publicly traded venture speculation, not a stable operating business.
13. My synthesis on OPTT.
I would characterize OPTT as no longer merely a fraudulent vaporware wave energy stock.
But also not yet a financially proven business.
It appears to have evolved into a legitimate but highly speculative maritime autonomy defense infrastructure play.
The technologies and contracts appear real. The strategic direction appears more coherent than years ago.
The geopolitical tailwinds are not imaginary.
But
The financials are still weak. Commercialization remains uncertain, and dilution risk remains extremely high.
so the central question becomes, can they scale revenue fast enough before dilution permanently overwhelms shareholders? That's the whole game here.